Wars are fought with weapons, but markets, they react in milliseconds. You see, when geopolitical tension rises, trillions of dollars, literally trillions, move across the globe before you've even finished reading the first headline. Today, we're going to deconstruct that reaction, second by second, dollar by dollar. The moment a crisis hits, this is the first tremor you see, a coordinated, immediate drop across all the major global indices. And you have to understand, this isn't just numbers on a screen. No, it's the digital footprint of pure fear. It's institutional capital, hedge funds, automated systems, all of them sprinting for the exact same, very narrow exit. So you might be wondering, what's really behind this initial chaotic sell-off? Well, to get it, we've got to break down the anatomy of panic itself. You know, how the market actually processes its most primal fear. And right here, this is the core idea. See, the market can handle bad news. A poor earnings report, a rate hike, it can price that in because it's quantifiable. But war? A war is a total black box of unquantifiable risk. It represents a future you just can't predict. And that is the real trigger for that initial mad dash to safety. And this gets us to what we call market uncertainty. Really, it's just a fancy term for not being able to predict what's coming next. In an environment like this, all those sophisticated models that Wall Street loves, they become completely useless. The only goal, the only thing that matters is protecting your capital. And that means one thing: sell first and ask questions way, way later. And this breaks down that chain reaction perfectly. It all starts with the geopolitical shock, right? Step one. That immediately triggers step two. All the big institutions start de-risking their portfolios. But then, and this is where it gets crazy, step three. The high-frequency trading algorithms kick in. They detect all this selling pressure and just amplify it exponentially, firing off millions of sell orders in microseconds. And the result? You guessed it. Step four, a massive spike in volatility, which, of course, just pumps more fear right back into the system. Okay, but that initial panic, that's really only the first act. The real accelerant, the thing that takes a regional conflict and turns it into a full-blown global economic event, well, that almost always comes down to one thing: the price of oil. Think about this. A massive chunk of all the world's seaborne oil has to pass through one single tiny choke point, the Strait of Hormuz. So any threat of disruption there, whether it's real or just perceived, sends an instant shockwave through the entire global energy market. It's a stark reminder of just how fragile the whole system really is. And this is the contagion effect in action. It's a domino effect. First, the threat of disruption makes oil prices spike. That immediately gets everyone worried about inflation because, let's face it, energy is a key ingredient in almost every single thing we buy. This puts central banks in a really tough spot. They can't cut interest rates to help the economy because that would just fuel the inflation fire. And with no help coming from monetary policy, the stock market gets even weaker. You know, there's a saying that just captures this whole dynamic perfectly. Rising oil breathes life back into the one thing that markets and central bankers fear most: that persistent, hard-to-control inflation. And that hesitation you see from policymakers, that becomes a massive headwind for the stock market. But here's the thing. In all this chaos, money doesn't just disappear into thin air. It moves. So where does it go? Let's map out exactly where all that capital flees when the panic really sets in. It's a fundamental rule of markets, right? For every single seller who's driven by fear, there has to be a buyer somewhere else who's driven by a totally different strategy. And during a crisis, what we see is a massive reallocation of capital getting underway, creating a very clear set of winners and losers. And you can see this rotation play out clearly across different sectors. Money starts pouring into assets that actually benefit from the crisis. You've got energy stocks right in those higher oil prices, and of course, defense contractors seeing a jump in military spending. But on the flip side, airlines get absolutely crushed by fuel costs. Businesses that rely on imports face total supply chain chaos, and entire emerging markets get sold off as investors run for cover. What's driving this whole thing is a really powerful psychological impulse. We call it the safe haven rush. It's basically a flight to quality, right? A totally predictable retreat from assets where the future is suddenly uncertain, and a move toward assets that have a long history of holding their value when things get stormy.
And when we talk about safety, two pillars stand out: gold and the US dollar. Gold is the classic, ancient hedge. It's tangible, you can hold it, and it's not tied to any single government's policies. The US dollar, on the other hand, is the world's reserve currency. So much of global trade and debt is priced in dollars that when a crisis hits, well, everybody needs dollars. And that demand naturally drives its value higher.
It all comes down to a basic human instinct. The first impulse is never to go bargain hunting. It's to protect what you already have. The search for safety always comes before the hunt for opportunity. All right, so we've dissected the panic, we've tracked where the money goes, but now let's get to the most important part. It's time to zoom out and separate that short-term chaotic noise from the long-term reality. And history gives us some really critical perspective here. I mean, look at the data. Whether it was the Gulf War, 9/11, or the invasion of Ukraine, the pattern is remarkably consistent. You get a sharp, painful drop, and then it's followed by a recovery. Now, the timelines might be different, but the rebound has always come. And here's the reason why. Because over the long run, markets aren't driven by scary headlines or by fear. They're driven by fundamentals, things like corporate earnings, economic growth, and human innovation. Think of geopolitical shocks as powerful waves on the surface. They're scary, for sure, but they are just temporary disturbances on a much deeper, much more powerful current. It's really something remarkable when you think about it. The speed of the fall is absolutely terrifying, but the speed of the recovery, that often surprises everyone. Fear is such a powerful, immediate emotion, but it almost always overestimates just how long the damage is going to last. So, let's distill everything we've talked about down to its essence. Geopolitics, that's what creates the volatility. Oil, that's the mechanism that spreads the economic contagion. And all that widespread fear that follows, well, that's what ultimately creates the opportunity. And that really brings us to our final, most crucial point. Reacting to every single headline is just a recipe for disaster. Real long-term wealth is not built in the panic of the moment. It's built on a plan. It's built on perspective. And most of all, it's built on the discipline to see through the storm. Because in the end, the panic always subsides, the shock fades away, and those fundamental drivers of growth, they always reassert themselves. So the real question isn't if the market will recover. The question is, will you have the discipline to be there when it does?